Hey there, thanks for tuning in. Welcome to Investing in Germany. And today I want to cover the MSCI All Country World Index. So, All Country World Index is really popular. I would say the third most popular investment vehicle in ETF in Germany. The first, I would say, is the MSCI World. The second is the MSCI Emerging Market. And the third is the MSCI All Country World Index. So, in today's video, I will cover through the fact sheet of the MSCI All Country World Index and also finally search for those cheapest option available for us to invest in Germany. And let's have a look at that as well. And before we enter into today's analysis, I would say that I would request you to go ahead and hit that subscribe button because the YouTube analytics says that 50% of my visitors are not subscribed to the channel. So I would really appreciate if you hit that subscribe button. It will really help the channel as well as me. So thanks for that. So what you see here is the fact sheet of the MSCI All Country World Index from the MSCI.com website. So I always go through the MSCI.com website for the fact sheet because it is where the documents are really up to date and they are obliged to maintain up to date documents. So therefore, I look for details only from the ETF providers or the index providers website. So I also recommend you to go ahead and do this and not to rely on any third party documents or third party websites that is available for us to do our research in, right? So MSCI All Country World Index, as it says, it captures the large cap and the mid cap of the 23 developed economies and 24 emerging markets. What are these? So these are, you can see it here. This is also from the MSCI.com website. If you just Google it, you will land in this page. And you can see that MSCI All Country World Index is nothing but a merger of MSCI World Index and the MSCI Emerging Market Index. So I would say this is something really good alternative for the lazy people who don't want to go for the 70-30 portfolio where they have to do some number crunching to divide their money into 70% to the developed market and 30% to the emerging market. Here with the All Country World Index, it takes the laziness to one level up where it says that you just put in the money and they will invest in both emerging market and the developed market. So that is what I would say the unique selling point here is. And there's not much difference between the 70-30 portfolio on here other than the weightage that you are putting into the developed market. So if you go ahead and look at the fact sheet, they are covering 2,884 constituents or the stocks or the businesses that they are investing in it. And I would say this is again really huge diversification. And I would say it's diversification overloaded, I would say. So if you look at how it has performed over the years, you can see that All Country World Index, which is here in the blue or the violet color, which is closely tracking the orange or the yellow, which is the MSCI World Index, because in All Country World Index, I believe they are investing the 90% MSCI World and 10% emerging market. And therefore, you can see that MSCI All Country World Index is closely following the MSCI World because most of the money that you put in the All Country World Index goes directly towards the MSCI World. So therefore, one could also question whether it makes sense to invest in All Country World Index if they are investing 90%, close to 90% into the MSCI World, which everybody can go ahead and directly invest in MSCI World Index, right? So that is one of the questions that you need to answer yourselves before you invest in All Country World Index. So if you go ahead and look at all these details or something that is irrelevant and misleading, I recommend you not to go ahead and have a look at these data because these has no value, I would say. So what is really important for us to see is that how they are investing their money in different countries. So first you can see that they are investing 60.52% in the America. So if you compare that where they are investing in the developed market, it is also mostly concentrated towards the American economy. So since here they are also investing a lot into the MSCI World, and therefore it comes here like America has the highest weightage, and then followed by Japan, United Kingdom, China, and France. So Germany is nowhere to be seen, and also India is nowhere to be seen. So if you see here, they are investing a lot into the information technology, the technology companies, and also financial sectors, which would, I would say, not do much well if we go into recession. If you go into recession, I would say industrials could do much fairly better than the technology or the financial sector, because once the economy goes into recession, the government tries to pump in the infrastructure development, and therefore the industrials companies would really be benefited from there on. So we have to really check and see what really fits. But if you're looking at a really, really long period of time, then it doesn't matter, like 20 years or 30 years, it doesn't matter. There is always a cycle, and you will just go through the cycle, and therefore, yeah, shuffling between different ETFs or something like that is not really making sense here. So just if you're looking for 20-30 years, just put in the money and just forget about it. Yeah, that is what you can see here. And the top 10 constituents, what you see here is also really concentrated towards the American stocks. So there is no company outside of America. So it's like an S&P 500 or MSCI World, and yeah, that's not much of a difference if you look at the top 10 constituents. And you can see that around 50% is already coming from the top 10 companies, and then you have 2,885 stocks. So the bottommost companies would have weightage like 0.01 or 0.02%, which has no significant value in the development of your portfolio. So that is one of the reasons I also don't like to invest in ETF, because it's a lot of diversification. If it's going to be 50 stocks, 100 stocks, something like that, or even 500 stocks like S&P 500, I would say, okay, I can go ahead and invest in, but then 1,000 stocks or 2,000 stocks, it's overloaded for me, and therefore I don't really go ahead and invest in the ETF or especially this all country world index. But there is a market for this, and people really want to go ahead and have a laziness in investing, and this meets that criteria, I would say. And therefore, yeah, it is one of the options available for the lazy people to invest in ETF. That is all about it. So now let's go ahead and search for the cheapest option that is available for us to invest in Germany. For this, I use the same old search engine, the Just ETF, which is really good. And I do recommend you to go ahead and have a look. It's more intuitive, and the user interface as seen as this, but I would say that it's not very complicated, or it's not very slow, and it just does the job what it is needed. So before going into it, I go for the usual screening process, where I go first for the MSCI. Then I also go for the replication method, where I go for sampling or full replication. I don't go to swapping. And I also like to have a really high investment asset under investment. So I go for larger at 500 million. And then use of profit is also really important, because my runway is quite long. So yeah, so let's see, I like to have all those dividends already reinvested into the stocks. I don't have to manage it. So that is also like a habit, right? So if you're not really into the investing, and if you're selecting the distributing, which means that you might get the dividend into your account, and then you need some discipline to again go ahead and invest in it. If you don't have the discipline, then you will go ahead and spend it. And then what happens here is that the compounding effect just vanishes. So therefore, I always say, my friends, that you have to go for accumulating, because it automatically creates an habit for you guys, and without you doing a lot of habitual changes that you needed for the investment. And then once we done that, then I go ahead and select for the ETF all country world index, where I see here at the top. And right away, I get only two options, and one is 0.2% TER, the total expense ratio. It is the amount of money that I'm going to pay the fund manager to maintain this fund for me. And the second is 0.4%. And therefore, it's very easy. You can see that the fund size is almost 6 billion, and then 0.2 is really cheap. And with iShares, we saw in our previous video that they are doing a fund of fund scenario. So we have to be really careful with the iShares, because I don't like to have fund of fund scenario in my ETF. I want the fund managers to go ahead and do their job, and not to give money to another fund manager to do their job, right? So that is one of my criteria, I would say. And we also always go ahead and look at the fact sheet. So looking at the fact sheet, what we have here is relatively very, very old investment opportunity here, investment fund here, and it is regulated in the Ireland, and it's all country world index, and total expense ratio is really cheap. 0.2 is extremely cheap, considering that we have to invest 2,885 constituents. So I would say it's really good. Optimized methodology, physical sampling, it's all good for me, and it's also accumulating. And the top 10 holdings. So if you look at the top 10 holdings, you can see right away that they are investing in a fund of fund. So this is the same situation that we saw in the emerging market fund, where they were investing in a fund of fund, and here it's the same. So therefore the 0.2 percentage, what they are saying here, it's not true, because if you dig deeper, then you can see another 0.2 percentage or 0.3 percentage which is being paid to this fund manager. So this is why I don't like to have iShares, because iShares is doing a lot of fund, and therefore whatever they say 0.2 percentage, even though from the surface level it looks really cheap, it's not that cheap, because 2,885 stocks all around the world, investing in it will take some time and it takes some resources, and for that which you have to pay, and therefore 0.2 percentage is not the right. I would say it's not really close to the effort needed to maintain the fund, and you can see that how they are really doing their mathematicals and financial engineering here. So fund of fund, I would not really invest in this fund because of this fund of fund. So what you see here is the United States 60.13. I think it's more or less close to the index. What I already see here is the China is pushed down below Germany. If you look here from the index itself, it should be above France, right? It should be the fourth biggest. But then as for the fund here, it is, I would say it's like sixth biggest. So they are not closely following the fund or the index. So this is not a good sign for me to invest in. So let's have a look at the other one which was available for us, which had a bit of higher cost from the surface level. I would say that they might not have the fund of fund here. That is my understanding. So what I can see here is that they don't have the fact sheet. So we have to go ahead and search for the fact sheet, for which you can go ahead and use this. So let's go ahead and look at those holdings. You can see that Apple, Microsoft, Amazon, Nvidia, so they are more or less okay. I can already see here Taiwan is coming in the top scenario here. So they're also not following the index very closely. So this is also on, I would say, a sort of a red flag, but then they don't have a fund of fund. So let's have a look at all the options that they are investing in. So you can go ahead and download here. Let me open the download document now. So what you see here is the downloaded document from the Spider. You can see here they are not investing in any fund of fund. At least this is what you can see here. I don't see any fund of fund here. And they're also investing in quite heavily. So how much stocks they are investing in is something that we can already check now. That is 2000 stocks is going to take a lot of time, and they are investing right about 2,445. So they are not investing 2,885, but they are investing in 2,445 stocks. So that is all about it. You can also see that they are investing in Russia, which is 0.000. So they are not investing in Russia. So it's all good. So this is all about it. If you're looking ahead and trying to invest in all country world index available in Germany, the cheapest option is the iShares, but then they have the so-called fund of funds where they are really promoting their own fund, giving money to their fund managers. They are making really good investment options for them. They are making a really good salary, and they are not really carrying us as an investor. I would say that in this case, Spider looks much better because there is no fund of funds, so everything is transparent. I would say it's much better option compared to iShares. If there is a fund of fund, it's really impossible for you to really track on what's going on from the ethical point of view and so on. So here we need to be really safe, and we are talking about 20 years, 30 years. So we should be really careful here when you're investing in it, not towards the fund managers who are really going, helping their own fund managers around them. So this is all about it. Thanks for watching. See you in the next video.